So in this lecture, we're going to conclude the number. And Berenson talks about in chapter 9, archaeologists versus detectives, and spends a lot of time talking about the SEC, who's pretty good about finding the bones after the dinosaurs died, where the detectives, like the short sellers, actually can uncover frauds. And he's pretty brutal on the SEC, and in some cases rightfully so, especially given my experience with them. But at the same time, the SEC has a big responsibility to fill, and everything that they do isn't related to fraud detection. But it is a bit of a problem because if you look at incentives, the SEC lawyers they don't have an incentive to go after or to catch big frauds because the lawyers that are there are not professional forensic accountants. They're not professional investigators. They want to get some experience working at the SEC. Then they want to go to work for the people that they regulated. In fact, Bernie Madoff said that the SEC lawyers that came to investigate him were more interested in dropping off their resumes with him than they were actually doing real investigation. And that's unlike the IRS or the Department of Justice. Like the Department of Justice, for example, those lawyers, the way that they want to make careers for themselves as prosecutors. So they want to prosecute big cases and make a name for themselves. Same thing with IRS investigators. They want to make a career at the IRS by busting tax cheats, right, and big tax cheats. And so their incentives, their career incentives, are in line with what they're charged to do. Where the SEC professionals, the lawyers there, their career incentives are not always aligned with what they're doing at the SEC. For example, I have a good friend who's a lawyer at the SEC, and he'd worked there for several years, and he finally got his dream job, his self-admitted dream job, which was working in compliance at a hedge fund. So now he's moving to New York to work at a hedge fund and make sure that the deals that they're doing there are in compliance with SEC compliance. So because of his knowledge with the SEC, he's attractive to these hedge funds. And so the individuals, the lawyers, the accountants that are working at the SEC don't usually stay there for a long time. They're looking to move into a company that they regulate. So they don't really have the same incentives that other fraud investigators do. In fact, the lawyers at the SEC are not generally trained to be fraud investigators, where short sellers have financial incentive to actually uncover fraud. So they're not trying to get some experience looking for potential places to short sell and move on to something else. They're actually trying to make money short selling, so they're looking for fraud. So you can oftentimes, when you look at people who are ineffective at things that they're trying to accomplish, it's because they don't have incentive to accomplish those goals. And Arthur Levitt, to his credit, as chairman of the SEC, identified a lot of the problems, and he called this what was going on in the 1990s the numbers game, where firms were not managing, they're not trying to report according to how well their company performed or their external reporting, their financial statements were not necessarily, the managers weren't trying to make their financial statements to be true and accurate pictures of financial performance. They were trying to report net income numbers that are consistent with what the analysts were forecasting. And so he recognized pretty early on that, hey, this appears to be just a numbers game. So the numbers that companies are reporting are not necessarily correlated with the underlying business of the company. But at the same time, as Berenson points out, it appears that the SEC was sort of powerless to stop the Enrons, the WorldComs, the HealthSouths, the Tycos, the Adelphias. All these things happened under the SEC's watch during the time that Leverett was trying to point out that this is a real problem. But in some ways, he was powerless to change things. We'll talk about some of those reasons why. Now, the SEC, their staff hadn't grown much since the 80s. And from 1998 to 2000, 30% of the SEC's employees left. So that's pretty common to have a lot of turnover. If your goal is to work at the SEC just for a few years, you get some experience, and then go to work at a bank or a hedge fund, then you're not going to stay very long. And these lawyers and accountants had little incentive to pay. The pay wasn't enough to get them to stay. I mean, they made more money going to work at a bank or a hedge fund afterwards. They were just trying to get the experience. And not only that, they didn't even pay consistent with other government agencies. And the corporate finance division of the SEC, they were supposed to, well, they had a goal of reviewing companies' A public company's 10K once every 3 years, so they at least wanted to get every 3 years they looked at a company's 10K. But in 1999, they reported that they didn't even review 9% of all the filings. So 91% of all the financial statements that came in never even got evaluated or looked at by the SEC. Then the enforcement division, whose job is to sort of go after these fraud cases, their pending case load doubled, but the staff only went up by 60% during the 90s. So they didn't have nearly enough staff to keep up with their caseload. So they really had to just pick and choose which frauds they were going to go after. And if you're trying to bust the maximum number of firms for committing fraud, you're going to go after smaller frauds. You're not going to go after an Enron that can defend itself, that's extremely complicated and large case, because it might take 4 and 5 years to resolve that case and tie up half your office. Or if you just go after small penny stock frauds and other things, you can wrap up a lot of cases in a shorter period of time and look like you're doing better. So the SEC, this enforcement division, had to prioritize the cases that they took, and so they went after small cases because they were just easier to prosecute and go after. But at the same time, one of the reasons why they weren't paying as high salaries as others, and that the number of employees there was shrinking or not growing at a fast rate, is because the people in charge of the government at the time, and whether it was George W. Bush, but it was more likely the Alan Greenspan, the head of the Fed, chairman of the Fed, and Scott Summers and others that worked in government as economists, they argued that the market was efficient. And since the market was efficient, there was really no need to have a regulator. If people are cooking the books, short sellers are going to sniff it out and short the stocks, and it's going to become public pretty quickly. And the market is sort of self-regulating because it's efficient. And that was the argument that they made. And there hadn't been a big stock market crash on the order of 1929, now for many, many years. And then when the market did go down in the 80s, it came right back. And so there was this perception that we'd sort of figured things out, and that we didn't. The reason why things happened, that we created a depression in the 20s, because in the 30s we didn't know what we were doing. We did everything wrong. But now we know how to manage the economy a little bit better. We learned our lessons, and so we really don't need much regulation. In fact, there was a sense that the SEC was just a burden on the economy and was a relic of the New Deal. And so because there wasn't a lot of support for the SEC, there wasn't a lot of political support, Levitt was sort of powerless to make the changes that he wanted to make. And there wasn't any evidence of any crises going on. So there wasn't a big public appetite to spend more money to increase regulation. And so Levitt basically had no allies. And he just had too many things to do with and not enough resources. So retroactively, he made mistakes by not working hard with the FASB to rule that they should expend stock option grants. And the commission spent too much time chasing these small internet scams and penny stock scams that they could prosecute quickly, and not enough time scaring large organizations, because the perception, if you're a large organization like an Enron or WorldCom, the SEC was going to largely leave you alone because they didn't have the resources to investigate you. And it's not all on the SEC. The prosecutors, they want to bust big cases, big fraud cases, but they have to analyze what's the probability that they could do it. And if you're looking at an Enron or a WorldCom, without evidence, strong evidence, like now they're in bankruptcy and their stock market and their stock price has crashed, it's going to be difficult to bring a fraud case against them, because they're going to defend themselves vigorously. And fraud cases are hard to prove. You have to prove that somebody intended to deceive the public, not just that they made some mistakes in their business model. They took on too much risk, but they actually took on too much risk, created financial statements that were fraudulent, and then deceived the public. And those are hard cases to prove. Now, once they fell apart and the companies filed for bankruptcy, and you could go through and, like he mentions that the SEC's archaeologists, you could pick up the bones and figure out what you were looking at. But they had a very difficult time doing that before that happened. And so it appeared that the SEC was intimidated by these large cases, and prosecutors, they're not the Department of Justice, they don't have the accounting background, so they're relying on the SEC to bring the cases to them that they think are the cases that are most winnable. And so if the SEC is not bringing cases to the Department of Justice, then they don't bring them on, because they don't understand the accounting. They rely on the SEC to explain it to them. Now, short sellers are better at this type of thing. They are smart. They tend to be cynical. They think everybody's doing some shady things. And in the 90s, pretty much they were right. There were a lot of folks doing shady things. The problem, though, is that these short sellers, if they're going to short, and we talked about what shorting is that's when you borrow the stock from your broker, from somebody else who owns the stock. So if you want to short Microsoft, for example, you talk to your broker, ask your broker, do you have shares of Microsoft that we can sell? And we can borrow from one of your other investors. We'll sell it now. Then when the stock price goes down, we'll buy it back. Then we'll give it back to your investors. So they're betting that the stock price is going to go down. Now, how do you know if the stock price is going to go down? Well, you've done your analysis. Like in the case of Enron, a famous short seller named Chanos, looked at Enron's financial statements and just said, you know what? I don't know how these guys are making money. Everything about their financial statements are opaque. When I read how they recognize revenue, I don't understand it. I don't see where their billions of dollars of revenue are coming from. And so he decided to short the stock, thinking that the stock price is overvalued and it's eventually going to come down, and then when it does, he'll make a bunch of money. And so the problem, though, was there was a lot of short sellers in the 90s that were looking at internet companies and not necessarily thinking that they were committing fraud, but think that they were way, way, way overvalued, which they were. So they shorted the stock, thinking that eventually the stock price is going to tank, which it did. But if you're selling short, the stock has to tank in a reasonable time frame, and it can't keep going up. Because if you buy the stock at, say, $50 a share, or if you borrow the stock at $50 a share and sell it, planning to buy it back in the future, well, it could go up to $350 before it crashes and comes down to to $2 a share when it turns out that the company has no real earnings and no real future growth, like Webvan and some of these other Pets.com and some of these other internet companies that had big IPOs. Their stock prices went through the roof, but then ultimately the business failed, and so stock price came back down to basically nothing. But the problem is, if you short the stock at $50 a share and it goes up to $300, essentially your broker's loaning you $250. And if you've done that over millions of shares, or even thousands of shares, that adds up quite a bit. So as the price keeps going up, your broker eventually says, you know what, there's going to be a margin call, and you've got to buy that stock back for us, because we're loaning you each time. Every time the stock goes up, we're loaning you more and more money. And so these short sellers lost a lot of money on internet stocks. Even though they were right, they just shorted them too soon, and the bubble went on longer than was anticipated. And a lot of investors that were going long, in a sense, investors that were buying stocks, they suspected that the market was in a bubble and the stock price is overvalued. But they still thought, well, I can make money in the bubble because I'm going to ride it while the bubble goes up, and then I'm going to get out before it bursts. So there was a lot of momentum trading. People weren't necessarily buying these internet stocks because they were good buys, and they thought the company was long-term going to be long and stable and profitable company. They were buying the stocks because they thought that's what everybody else was buying, and that it was going to increase, the stock price was going to increase in the short run, and then they would get out before the bubble burst. Well, the short sellers that were right, that knew the bubble was going to burst, just didn't recognize how long the bubble was going to go on. And so they had to unwind their short positions before the bubble burst, and so they lost a bunch of money because they had to buy it back when the stock price was high, and couldn't wait until the bubble burst and then it collapsed. But so these short sellers, they still unearthed many of the frauds. The most famous one being Enron. Like I said, Chanos was the one who identified that pretty early on. Well, not early on, but he was the first one to sort of point out that Enron was doing some shady things. And but the shorts did identify a lot of other frauds that were out there, and because they were looking at the financial statements and they were doing the horizontal and vertical analysis, they were looking at the non-financial information. They were doing all the things that we talked about in this class, and they identified, hey, this company must be doing something suspicious. So they identified a lot of the frauds, a lot more so than the SEC did. So then in chapter 10, we spent some time talking about this bubble and how it just starts to grow, starting in 1995. I mean, it had been getting bigger and bigger in the early 90s, but then it really started to take off. He mentions in August 19th, 1995, Wall Street began to blow a bubble that wouldn't pop for almost 5 years. And then Netscape, so an interesting case. So the internet's fairly new, and Netscape realizes that I can create an internet browser where people can just search my browser and find the websites they're looking for. They don't have to go directly to the website. And at the time that was sort of revolutionary, and everybody thought, well, this is brilliant. Netscape's going to corner the market on web browsing, and everybody's going to go through Netscape. And so their growth is going to be exponential. It's going to be astronomical. So everybody wanted a piece of Netscape. So Netscape was this new web browser, and so they planned to take the company public. And of course, people were thinking, well, this is going to be the real big challenger to Microsoft. And they got Morgan Stanley to be their underwriter. And originally, when they were going to go public, they were going to sell 3.5 million shares of stock on the NASDAQ at $14 a share. That's even though the company at the time only had $17 million in sales. So $17 million in revenue. That's not profits. That was just sales. They were likely didn't have positive income. They looked at a loss at the time. But people thought, well, that doesn't matter because they're going to grow so fast that they're quickly going to be worth billions of dollars, because that income number is going to or that revenue number is going to go from 17 million to 10 billion in just a few short years. And so we need to get in on this IPO. And they ignored the fact, like we always do. We tend to think that this new technology is going to be the wave of the future, and that there's going to be no competition, that revenue growth is going to be exponential, as long as the eye can see. And they ignored the fact that Microsoft wasn't going to take this laying down. They had a hoard of cash that they're sitting on, and they could release their own browser, as soon as they wanted to, and then they could actually embed that browser in your operating system. And so people didn't really recognize that maybe Netscape didn't have it all figured out. But when you think that this is the next big thing and there's money to be made, then everybody sort of abandons reason and just thinks, okay, I just want to buy this stock no matter what the price. And so Morgan Stanley decided, instead of offering $3.5 million shares at $14, they were going to offer 5 million shares to the public at $28. The Wall Street Journal saying they don't get any hotter than this. And like newspapers, like the Wall Street Journal, they have every incentive to report positive news and exciting news, because that's what people want to hear. They don't want to hear that the market's doing poorly and that companies are committing fraud. They want to hear positive news that they're going to make a bunch of money. That's what sells newspapers. And so the company goes public, and by December that year, the stock price actually reached $171. So it went from 28 to 171. So even if you were a short seller and you thought there's no way that this $28 per share at Netscape's a reasonable price, and I'm going to short the stock, thinking that Microsoft's eventually going to come out with a browser and then it's going to run Netscape out of business. Well, you could short it at 28, but then if it goes up to 171, you might not be able to hold your short position that long. So that bubble went that long and went that high. And then 1997 was the last year the company was an independent company. In 1998, Netscape was taken over by AOL. So that was it. And the stock price came back down. So obviously we think, well, Wall Street must have learned their lesson from this. But it's sort of the contrary to that. And not only was it not a cautionary tale. It was more of a, see, we can make a lot of money on these IPOs because look, it went from 28 to 171. So just get out before it drops. So any IPO that's hot like that, just even if it's a bad long-term buy, jump on it right away because it might go from 28 to 171. You could make a bunch of money. So a lot of people did make money on Netscape. I'm at the expense of people who bought at 171 and then rode it on the way down. So everybody thinks that they're going to buy the IPO on the way up. So rather than being a cautionary tale, everybody thought, I want to be the next, I want to get in on the next IPO and ride it up from 28 to 171. I don't care what happens in the long run. So that started an IPO frenzy. So anybody who had a .com after their name wanted to go public. You didn't have to, it turns out, like Netscape showed, you didn't even have to have very much profit or even net income to go public. As long as you could sell the investing public that your growth was going to be astronomical, then you could go public anytime you want. And people thought, even if you don't have much money or much sales, you're going to grow rapidly. So therefore, I'm going to buy your IPO and just ride the wave like the $28 to 171 like Netscape did. So every institutional investor, which are the mutual funds, the pension fund managers, they all wanted to buy the hot IPOs, and then they could generate big returns for their funds doing that. I mentioned that analysts were too busy to rate companies. They were, on MSNBC and other things, and they wanted to rate every company right as a buy, because if your analyst was saying Netscape was a buy, was a sell, then if Merrill Lynch's analysts had been saying that, Merrill Lynch or Morgan Stanley wouldn't have gotten the IPO underwriting business. So you wanted your analysts to say positive things about every single company because you wanted to underwrite either their IPO, or maybe they're going to do a secondary offering, or maybe they're going to sell bonds. Whatever it was, you wanted your analysts to say positive things about them so that the company, you got in the good graces of the company, and then you could do their underwriting work. And so these big investors, they didn't really care about how much research the analysts were doing. They just wanted to know, are you talking to management, and can you give us good trading tips? And analysts became a little bit of a celebrity because they were the ones that analyzed these companies like Netscape, and so everybody wanted to talk to them and say, hey, who's the next big thing? Right? Who do you recommend we buy? And because they had incentives to say positive things, they were saying ridiculously positive things about everybody. And so that obviously those conditions lead to a bubble. And so Standard & Poor's 500 index rose 34% in 95. The NASDAQ Composite Index rose 40%. And even Alan Greenspan, this free market economist who's thinks the market is totally efficient, starts to get a little nervous. He says, how do you know when an irrational exuberance has unduly escalated asset values? So he was one that, as a efficient markets economist, thought, well, assets don't get overvalued or undervalued because that's the true value, because markets are always efficient. Even he was starting to waver there. And then in 1997, the Wall Street, whether it's the NASDAQ or Standard & Poor's Index, everything's going well. So nobody wants to report bad news that, hey, maybe this thing's going to crash, right? Nobody wants to hear that. When you're at a party, you don't want to hear that there's potentially going to be bad news and you're all going to have to go home. And then just like the 20s, we had just regular folks, you and me, who quit their jobs and just started becoming traders for a living. And because of E-Trade and then Scottrade and others, rather than charge a commission on the sale as a percentage of the stocks that you bought and sold, they would just charge a flat fee of like $8 to make any trade. And so it became cheap and easy to trade stocks, and so all these regular Joes jumped in the market and just started buying stocks, became day traders. So they would use all their money, they'd buy stocks, they'd be looking at internet chat rooms, trying to figure out what analysts are saying and who's going to be the next hot buy, and then buying those stocks and riding the wave for the day and then closing out the account at the end of the day. So if you're buying stock in the morning and selling in the afternoon, you're obviously not a long-term value investor. You're just trading on momentum. And so you're not reading the financial statements trying to figure out if they're good buys. You're just trying to listen to analysts and watch MSNBC and figure out what everybody else is buying so that you can buy it too and ride that wave up. So there's an explosion in trading, which is an ominous sign for Wall Street, that it's speculative and it's not based on value investing and long-term stability. And mutual funds start growing like crazy too. That's partly because everybody starts putting their money into 401ks. The pension funds, companies stopped providing pension for employees like the old pension fund days, like when you worked for Ford and you just got like 50% of your salary after you retired. Companies weren't doing that anymore. They just said, you know what, we're just going to put money into a 401k for you, and then you're on your own after retirement. And so since companies were doing that, everybody was taking their 401ks and investing in mutual funds. And so stock funds grow 240 billion in 1990 to 4 trillion in 2000. So huge increase over the 90s. And thousands of new funds opened up. It's obviously extremely competitive when there's that many funds. And then by the end of 1997, the average stock fund had cut its cash position to 6%. So a lot of funds hold on they hold back a certain amount of their fund as cash because they want to look for good values. But when the market's going up like this and everybody's trying to buy the next hot IPO, you can't afford to have your money in cash. You've got to have it in the hot IPO stocks. And everybody was following what these fund managers were doing because they knew that as money from 401k funds and these mutual funds were moving into certain stocks, it was going to create demand for it and increase the stock price. And fund managers, they weren't paid. They came to think their job was to get paid to invest in stocks, and not only stocks but growth stocks. So stocks with high PE ratios. So stocks that have high price to earnings ratios. So it's a high stock price relative to the earnings. The reason why the stock price is high relative to earnings is because they think the earnings are going to grow rapidly. And so high PE ratio stocks tend to be considered growth stocks, not overvalued stocks because the price is too high, but it's valued high because it's going to have huge growth. So companies with high PE ratios continue to have higher and higher PE ratios because the price relative to earnings just kept going up. And they were beating value stocks that appeared to have high dividend yield and low PE ratios. Those stocks weren't increasing nearly as fast, the stock price, as stocks that the price was already high relative to the earnings, and it just kept getting bigger. And so the thing to do at the time was to buy what everyone else is buying, right? Not what Warren Buffett does, where he looks for values and buys what everybody's not buying. The sound policy was, it doesn't matter if Netscape's overvalued, everybody's buying it, so the stock's going to go from 28 to 171, and I need to ride that wave. Instead of thinking, I think Microsoft's going to compete with them in the long run, I don't think that's a good buy. I'm going to sit back and I'm going to buy the railroad that nobody's buying that pays a high dividend. Right? So quarterly reporting periods were tracked to predict stocks. So companies, they have to report their annual earnings, but quarterly they have to file their 10Q with the SEC and report how well they're performing quarterly. So the quarterly financial statements don't have to be audited. So usually 10 days or so after the quarter, there's a press release and the company reports how they did that quarter, and there was a new earnings per share number to digest. And so everybody was anxiously awaiting those quarterly reports and those earnings per share press releases. And then obviously if the company beat their earnings per share expectations by their analysts, and their stock price would go up. If they didn't beat it, their stock price would go down. So that's why everybody was paying attention to it, because they could see for companies that beat it, I'm going to jump in, buy those stocks, and ride the wave up. And so companies were putting out these releases and talking about, not about the current results, how well they perform, but how well they're going to perform, because these are growth stocks. And not how do we do last quarter, but how are we going to do in the next several quarters? And that's all people wanted to hear. So we could say, yeah, we didn't have any earnings this year or this quarter, but we're going to grow like crazy, and so buy our stock. And then Berenson mentions that, in the past, nobody really used this consensus analyst forecast. There were analysts that were out there forecasting stock prices and doing a lot of really good research, analyzing how well a company's going to perform, and then predicting future performance. But in the past, they would give ranges. So they would say Coke, for example, 1975, the analysts might predict Coke, and for their 1996 earnings numbers based on what we're seeing with bottling industry and the coal industry, we project that their earnings per share is going to be between $1.31 and $1.34. And then they would produce a big binder of research that gives their investors. Investors would look at that and go, okay, I see Coke's a good buy. I think their stock price and their earnings per share is going to be, in this range in the future. That sounds like a good buy to me. But then the analysts stopped reporting ranges, and they would just report one number. Instead of saying, we think earnings per share is going to fall within a range, it's going to fall at $1.32. And then there became sort of a cottage industry of data analysis gatherers like IBIS, and they would say, look, there's 20 analysts that are following Microsoft, and so there's 20 analysts. There's one or two for all the big brokerage houses, and so I'm going to take all of their earnings per share numbers that they're predicting for Microsoft, and I'm going to aggregate them and take the average. And so what's the consensus? What's sort of the average earnings per share number? And they were all coming in with very similar numbers because they're talking to management. Management's basically telling them how well they're going to perform. So they would all come up with, somebody might say $1.31, then you have 10 analysts say $1.32, somebody might say $1.33, but these data gatherers would say, like IBIS would say, well, the consensus forecast among all of these analysts is $1.32. And that was the number that everybody targeted. So they said, okay, now that we have consensus on these 20 analysts, let's see what Microsoft actually does, right? And companies that fell just 2 cents short of their earnings per share number. So it's supposed to be $1.32, you came in at $1.30, you lost 2% of your value. So your stock price went down almost immediately 2%. And then not only do we have the number, we started to have these whisper numbers. So you have companies like Cisco that consistently beat their earnings per share targets by a couple of cents every quarter. So if you predicted $1.32, they would consistently come in at $1.34. And so what would happen is, like in the internet chat rooms and stuff, when people were discussing stocks, they'd be saying, hey, the consensus forecast for Cisco is $1.32, but we're hearing $1.34. And everybody would start whispering and speculating that the number was going to be even higher than that. So then you had whisper numbers, not even the actual number that you had to try and get to. You had to get to the whisper number. And if you missed the whisper number, your stock would go down because everybody started trading based on, it's not $1.32 that we think, it's really going to be $1.34. And obviously, companies knew that they had to manage to that number, or their stock price was going to go down potentially by 2 cents or 2%. So they were stressed. Then 1998 came, and it turns out that there were some frauds. So you probably, as you read them in the book, you read about Sunbeam and Sendan and Oxford Health. So there starts to be some cracks in the foundation that maybe the financial reporting is not as solid as everybody thinks. And you have the partner in charge at auditing, Terry Strange. So there's probably more pressure to achieve results than any time I've seen. So it looks like everybody's feeling a tremendous amount of pressure to meet this earnings per share forecast, this consensus forecast among all their analysts. And so you think, well, since it turns out that some of these companies were committing fraud, that the investment public might get a little skeptical at that point. But they don't. So they just sort of argue that, yeah, there's always going to be a few Sendance and Sunbeams with some overzealous CEOs who manage their numbers. But those are few and far between. For the most part, the reporting is accurate. People aren't manufacturing profits out of thin air. And so the media wasn't interested in spending a lot of time talking about the Sundance and the Sunbeams. The Sendance and the Sunbeams, because, like I said, that doesn't sell newspapers. When you're at a party, you don't want to read gloom and doom that the party's going to shut down and everybody's going to have to go home. You want to read positive things and that you're going to have big returns for as long as you can see. So, and 1998, S&P's trading at 25 times earnings, which is traditionally a really high price to earnings ratio. 25 PE ratio is indicative of a growth stock. And this is the S&P. This is not just the NASDAQ. So, can you really think that the company can grow, that the country can grow at a rate that's 25 times its earnings, that justifies that type of price to earnings ratios? Well, it's unlikely. The NASDAQ at that point breaks 2,000. It's up 25% for the year. And then something happened in 1998 that should have sent shockwaves through the investing community. And we're going to read about this same event in Fool's Gold as well. But there was a large fund called Long-Term Capital Management, and they were highly leveraged, which is the same thing that happened in 2008 with Bear Stearns and Lehman Brothers. They didn't have enough equity for how much money they borrowed. So they had a fund that was worth $125 billion, and 120 of it was borrowed money, and only 5 of it was money that investors put in. So that's great if the fund goes from 125 billion to 100, goes up 10%, so it goes up $12 billion. That's great because that $12 billion is shared by those investors that put in the $5 billion. So that's a huge return on the $5 billion. But the problem is if the fund goes down 10%, and it goes down in 1 year from 125 billion, goes down $12 billion, you wiped out all of your equity. So you couldn't have a down year if your equity was so thin. And unfortunately, long-term capital management made some bad decisions. And they bet that worldwide interest rates would converge, and they didn't. And so their fund went down from 125 million, dropped 125 billion, dropped several $billion dollars in asset value, and it wiped out all their equity. So now their assets were worth less than what they owed, than the $120 billion in debt that they had. So they were bankrupt. So what do you do at that point? Well, because when you go bankrupt, then you declare bankruptcy. A judge comes in, and they sit down and think, okay, well, your fund's not worth $120 billion anymore. It's only worth $100 billion. So you got $20 billion that you're not going to be able to cover if you sell all of your assets. So what they do is they say, all right, let's liquidate all of your assets and then pay back your debtors what you can. So you got $120 billion in debt. You only got $100 billion in assets. So you sell those $100 million in assets, and then you pay off the creditors, and they get maybe 80 cents or 78 cents on the dollar. Well, that's what happens in normal bankruptcy. The problem with long-term capital management was their assets were worth so much money, over $100 billion, that if they turned around and liquidated this fund, it was gonna be like a fire sale, and the assets that they were selling were going to the price was going to go down, because if you throw that much supply onto the market for the products that they had, then the demand and the demand's the same. The stock price, the price of those assets is going to go down significantly. And so they recognized that was what was going to happen. And then other banks who have those same assets, they have to write their assets to market value for these marketable securities. So if there's a fire sale on the value of those assets, the price drops significantly, then banks were going to lose a significant amount of money as well, because of this fire sale that long-term capital management was going to have to go through. And so people were concerned, and the assets that they had with bonds, people were concerned that if they threw all these bonds on the market, and drove down the bond prices, then it was going to hurt everybody. And so it might push other banks into insolvency. And so because this bankruptcy for LTCM was looming out there for a while, stocks and bonds went down, thinking, hey, this could really send shockwaves through the market and potentially cause others to go bankrupt as well. And so people were obviously concerned. Well, Alan Greenspan at the Fed recognized that, hey, this is going to be a problem. So what he did is he talked to a consortium of banks and said, you know what, technically, long-term capital management's insolvent. They lost their $5 billion in equity. They're probably down another $5 billion. They're going to have to pay their creditors back. They don't have the money to pay them. Nobody's going to loan them money because they can't pay back what they have. But it's going to be bad news for all of us if, and you banks in particular who hold the same bonds, if there's a fire sale on these bonds. So what we need to do is loan them some money, let them prop up the fund for a little while, and then let them unwind their their balance sheet in an orderly fashion over a year, 18 months, 2 years to liquidate all these bonds, then it won't be a fire sale and it won't drive the price down significantly right away, and it won't hurt you guys. So these banks realized that they had their own personal incentive to keep long-term capital managed propped up, for a while until they could unwind this position. And so this consortium of banks did put up $4 million in new capital and just took over the fund, ran it for a while until they could unwind it. At the same time, Alan Greenspan said, you know what, I don't want the market to freak out. It's starting to dip a little bit. I'm going to cut interest rates by a quarter of a point, and that's going to let people know that, hey, if there's shaky times in the economy, we're willing to cut interest rates a little bit. And that's a good sign, because when the Fed cuts interest rates, that's the rates that the banks loan to each other. Well, if the banks can borrow money at a lower rate, they can lend money at a lower rate and still make money. So that likely meant that mortgages were going to go down, car loans were going to go down. So when that happens, then more people buy cars, more people buy homes, and the economy sort of takes off, improves. So people like interest rate cuts because it's going to lead to borrowing and spending, and borrowing and spending leads to growth in the economy. So Fed cut the interest rate and sort of stabilized the economy. And then next month they did the same thing. They cut rates again, and then people went, "Oh my gosh, this Alan Greenspan is brilliant. He saved us. Right? He saved the long-term capital management. The shock wave that would have happened that potentially could have brought the market down. He cut interest rates to make sure that people were really confident that the economy was going to keep growing." And so by the end of October, the market had risen more than 20% from the lows where they were. And everybody thought, well, Greenspan, he knows what he's doing. They wrote a book about him called The Maestro, said basically he saved Wall Street. And so there's a perception that, we know what to do now. There's never going to be another 1929. If the market starts to dip, or if there's cracks in the foundation, we know how to fix them. We can put together consortiums of banks, we can cut interest rates, we can do whatever we need to do to make sure that a stock market crash doesn't cause problems to the broader economy. And Greenspan knows how to do that now. And so there's this perception that Greenspan could always save us. The problem, though, is it creates the illusion that there's nothing to stop another bank, another long-term capital management, from being too thinly capitalized by not having enough equity. So it encourages borrowing because the thinking is, well, I can borrow as much as I want if my fund does go bankrupt, like I make a bad decision like long-term capital management did. Greenspan will just bail us out. He'll figure something out, get a consortium of banks together. And so it essentially encouraged people to continue to take risks, and encouraged risky and undesirable behavior. And so this perception that Greenspan could save the economy at all costs was a double-edged sword. He did save it in the short run, but in the long run, it didn't change anybody from doing what they're doing. And so the market just went merrily along, sort of blind to the fact that they're blowing this huge bubble. And when in fact the Fed's responsibility, the Federal Reserve, is to avoid bubbles and troughs. So Greenspan, we did a good thing by putting the consortium of banks together. The lowering the interest rates and then keeping interest rates low for so long during a good economy led to too much borrowing and too much spending and not enough saving. And so why save money when you can borrow money and buy internet stocks and get 40% returns every year? So it encouraged borrowing and investing in risky assets that creates a bubble. So what he should have done is recognize that we're in a bubble and actually raised interest rates and brought that bubble down a little bit, and so that it never grew as big as it never should have gone as big as it did. But he only went one way with interest rates, which is down. He never brought them back up. And so as a result, investors didn't learn their lesson. They believed Greenspan would never let the market fall too far, too long. And the Fed was too quick to cut rates. And consequently, from those rate cuts, and then we cut them again in 2008, we're basically at zero. It cost banks zero to borrow money. And so there's no bullets in the gun if there's problems in the future. We can't lower interest rates because they're on the bottom already. So it's a tricky business lowering interest rates and never raising them. So in 1999, even though there was those stocks, well, Greenspan saved the day. So everybody's loading up on technology and biotechnology stocks. And 80 million Americans own stocks or mutual funds. 10 million had online trading accounts. And then you had Qualcomm, which is sort of the same position as Netscape. You had an investor there saying that their stock price is going to double again. And so everybody wants to believe that. And so it didn't matter what your valuation was. The only thing that mattered was, are you going to be the next Netscape? I don't care if you're a good company or if you're a bad company. This is just like gambling. So I'm just going to put my money, on the wheel and see what happens, during this IPO. And so IPOs raised more than $63 billion in 1999. And what we're going to learn is that was probably the very worst time to be investing in stocks. So Greenspan recognizes that, he cut rates too low and that the market was getting way, way, way overheated. And so he tries to raise interest rates, but by this time nobody cares. I mean, nobody cares that he's raising interest rates because the mentality is that the market's not going to crash. The economy's in great shape. And if anything does happen, Greenspan will save us. And then in January 2000, a Fortune magazine that said this market is stark raving overvalued and it will not last. But nobody cared. Nobody wanted to hear it. All they wanted to do was buy winners. And you had these analysts that are sort of many celebrities on MSNBC and Lou Dobbs predicting, that things are going to continue to be the same. And the way that they were able to justify such high valuation, price to earnings ratios that were so high was because I remember this time, the thinking was that, securities analysis by Graham and Dodd, you throw all that out the window. This is a whole new world that we live in with the internet. It's going to change the way that people spend money. And so it's going to change how fast stocks can grow. So PE ratios that appeared to be high in the past are not high anymore because growth is going to be so rapid that any PE ratio is justified. So there's a perception that we're just in a whole new world and that we had to rethink traditional price to earnings ratios. And like I mentioned, the Fed, like Greenspan, tried to raise these rates, and there's an interesting quote, I think, at some point where they said, if there's a party going on, the Fed's job is, before it really turns into a rager, is to, start flicking the lights and shut the thing down. But instead, they were just pouring, alcohol into the punch bowl and just kept the thing going. Then in 2000, February 29th, 10 days before the NASDAQ topped out at 5,000, the S&P peaked. Shortly after that, at 1,500, price to earnings ratio is 29 to 1, which is just astronomical. Dividend yields 1%. So by definition, this is an way overvalued, traditionally stock market. But even though it's way overvalued traditionally, PE ratios are outrageously high. 75% of the analysts' recommendations were buys or strong buys, which is the highest it had ever been, that ratio had ever been. So no analyst is predicting bad news. Every single company, three-quarters of companies in their minds are buys or good buys. And certainly these are all internet companies. The 25% that weren't strong buys or buys were probably, like I said, the railroad companies and the steel companies. And as Berenson points out, it turns out that in early 2000 is the worst moment to buy stocks in 70 years. And so it's funny. So bubbles are fun until they pop. And then in April 2000, the Dow starts to waver. So it drops down 617 points. The NASDAQ loses 10% of its value. And of course, once the market stops going down, then there's no point in doing an initial public offering because there's not as many buyers out there, so you're not going to raise as much money. So IPOs taper off. And then turns out that we have the short sellers like Chanos finding Enron, but it wasn't just Enron. It was WorldCom, it was Tyco, it was Adelphia, it was HealthSouth, it was Computer Associates, it was Lucent. And so all these companies turned out to be fraudulent. And what we find is that when the economy's going up and the market's just going up, you don't really have to look at the financial statements because everybody's a winner. But when the market starts going down, then you have to find good stocks, and people go back and start looking at the financial statements again, and what they found is that a lot of these were frauds. And Lucent leads it off. They had a variety of accounting gimmicks, obviously unrealistic growth targets, and it's interesting. They mentioned that the only good investment that Lucent made was in a golf course, which is a hard asset. Computer Associates was just making stuff up. They were given billions of stock options to their executives, and they were manipulating revenue. And the interesting thing about Computer Associates is they were reporting under GAAP, but then they're also saying, that GAAP number, for net income, that number's all wrong. Like GAAP doesn't apply to us. We've used pro forma numbers, which is our own version of accounting, and under our own version of accounting, we're doing much, much better. Everybody thought, well, under their pro forma numbers, their earnings are great, and so, but it turns out that their pro forma numbers are the numbers that they said were the numbers that best reflected the financial position of the company. Did not reflect the financial position of the company, because they were double booking revenue and a bunch of other things. So they wound up being a fraud. And again, the SEC didn't uncover any of these. Enron crumbles because they Chanos starts shorting him, and Bethany McLean at Fortune calls him up and says, "Why are you shorting Enron?" And this is a time when when the market starts to go down, then people don't mind. They want to find out what's going on. It's sort of like you don't want to read there's an earthquake, but when there is an earthquake, you want to find out what's going on. So Bethany McLean wrote an article about why people are shorting Enron. And it turns out they had really complex financial disclosures. They were using mark-to-market accounting. But if you heard Sharon Watkins speak the other day, she talked about, she was a whistleblower at Enron. She said that there wasn't a market for a lot of the investments that Enron had. So Enron had their own models on how to evaluate those investments, how to value those investments. And so they were using mark-to-model accounting. So they were saying, this is what the value should be, so let's write it up to that. Then Form 5 is the form that you file with the SEC if you're management to let them know how much of your company stock you're selling. And Lay was selling $70 million of his own stock in Enron. At the time, he was telling other people to buy it. And that's sort of a famous story about how he was the one saying Enron's a great buy, telling his employees not to sell, but he was selling. He actually appeared to be a true believer. He actually appeared to be delusional. He was selling not because he wanted to get rid of his Enron stock. He was selling because his Enron stock collateralized some of his loans, and he had to sell. But other executives like Skilling knew that it was in bad shape, and they had sold their stock, over $1 billion of Enron stock during this time, even though they're telling employees to buy. And then we had the former head of Andersen wrote an editorial to the Wall Street Journal that basically blamed everything for Enron's collapse except for a failed audit. He said, if we had made mistakes, we'll own up to them, but he blames everybody. He says the accounting rules were too complex, and they were using these complex financial instruments that people didn't understand, but they invested in the company anyway. Kind of like it wasn't our fault that you invested in Enron and it collapsed. The accounting standards were too complicated for us to interpret, and so we didn't do anything wrong. And so he blames everybody, including Lou Dobbs, for Enron's collapse, except for Andersen. And the Waste Management didn't prove anything to Andersen. They promoted the audit partners who were involved in that fraud. David Duncan was the audit partner at Andersen, and that was over the Enron audit. And they basically said that was his fault. He was a young auditor, young partner, and Andersen just blamed it all on him. And they were found guilty of a felony of obstruction of justice for shredding documents. It was later overturned by the Supreme Court that basically said that they were just doing what all audit firms do. They were following their own policy and getting rid of their documentation that wasn't germane to the audit. And so when I heard that Andersen was shredding documents, I thought it was perfectly normal, because having been an auditor, the only evidence that you did a good audit is documentation. So you're not going to shred your work papers or anything related to Enron that could show that you did a good audit. What they're shredding was like unrelated stuff, tangential stuff that they were getting rid of, but it sounded bad. But they were following their own policy to get rid of information that's not in the work papers, and that's why the Supreme Court eventually overruled it, because they said they weren't really they weren't shredding documents that because they got subpoenaed. They're shredding documents because they're following their own internal policy. But Andersen could not have survived Enron anyway, especially on the heels of Waste Management and then WorldCom. No, all their clients were bailing on them, so they were gonna go bankrupt anyway. Then Tyco, they called the last great scam, and Dennis Kozlowski was the CEO of Tyco. He not only was manipulating the financial statements, he was also looting the company. He was holding a $2 billion birthday party for his wife, with Jimmy Buffett on a private island, charging it all to Tyco. He had like gold faucets in his apartment and things. So he was looting the company as well as committing financial statement fraud. He was going to try and hide the fraud because Tyco was a big conglomerate. He was going to sell off and spin off a bunch of the business, a bunch of their subsidiaries, and then just spin off all the bad investments into the subsidiaries and say, oh, see, Tyco's in good shape, but these subsidiaries that we spun off, they were the ones in bad shape. But he got caught before he was able to do it. And then, like we always do when there's a big fraud or a crisis, we create a new government agency. So back in the 30s, we created the Securities and Exchange Commission. And in the early 2000s, we created the PCAOB. So Sarbanes-Oxley became law and increased the SEC's budget and increased penalties for management when they committed fraud. It also said the partner in charge of each publicly traded company, that partner in charge, the auditor who's in charge, has to rotate off every 5 years. So a partner can't stay, if you're auditing Enron, you can't stay there for more than 5 years. You got to rotate off. They also imposed a rule that said the CFO and the CEO have to sign a statement saying that they've read the financial statements, that they understand the financial statements, and that they're not aware of any fraud. Because what would happen is you'd have Bernie Evers, at WorldCom. Once the fraud was discovered, he said, well, it's the CFO's fault. I'm just a poor high school wrestling coach. Because that's what he used to do in his early life. And I don't really understand financial numbers. That's why I hired the CFO. So if he was doing something, manipulating the financial statements that had nothing to do with me, I don't even understand them. And of course that didn't work. And he went to jail for 25 years. But that was the typical response to charges for the CEO, is that it wasn't my fault. Right? It's not illegal to be stupid, but it's illegal to knowingly mislead the public. So they're always trying to blame it on people below them. So Sarbanes-Oxley said, none of that. You have to sign a statement, whether you're the CEO and the CFO, that you understand the financial statements, you prepared them, you're taking responsibility for them, and that there's no fraud. And the Public Company Accounting Oversight Board, the PCAOB, now they were going to be the ones that were going to oversee the external auditors. External auditors are no longer going to be self-regulated. Because in the past, the way they regulated themselves is Andersen would, once a year, they would go look at Ernst & Young. They would do peer review. So Ernst & Young would look at PwC. PwC would look at Deloitte. Deloitte would look at KPMG. Then the next year they would rotate. And surprisingly, the audit firms never found any problems with the other audit firms' work. And then they were the ones, the AICPA wrote the accounting standards. And not the accounting standards, that was the FASB, but they wrote the auditing standards. And with the creation of the PCAOB, which came under the direction of the SEC, the Public Company Accounting Oversight Board now was responsible for writing the audit standards, basically telling the auditors what they needed to do a good audit. And they also inspect the auditors regularly. For the big four firms, they inspect them every year. But if you want to audit a publicly traded company, you have to register with the PCAOB now and agree to be inspected by them and follow their standards. So there's no longer with the external auditors be self-regulated. The problem that I have with this, though, is that it's not so much that we created a government agency. The PCAOB is probably fine, but we had regulation at the time. We had the Securities and Exchange Commission, and there's never a situation where the government steps back and says, why doesn't the regulation we had work? So what reforms do we need to make within the SEC to make it work? And so rather than just keep layering on more levels of complexity and more levels of regulation, what they ought to do is step back and say, why doesn't the regulation we currently have, why is it not working? And can we fix that? Right? And before we add new regulation that's not going to work. And we did the same thing in 2008 with Dodd-Frank. We had more regulation, created another government agency, the Consumer Protection Agency. And we never step back and say, well, we have an SEC. Why are they not catching these things? And what can we do to improve that before we start thinking, what's more regulation we can put on? We clearly need regulation, but we need regulation that works versus just every time we just put new regulation instead of revising and looking at what doesn't work. And Michael Lewis, he's the one who wrote The Big Short and Liar's Poker, a former Wall Street executive who wrote books about Wall Street. And he mentioned that some fraud's healthy. In some ways, he's right. We could stamp out all fraud if we wanted to, but that would require auditing every single transaction, and we don't want to do that. So some fraud, there's always going to be fraud on the fringes. It's just how much regulation can we do to get down to a very minimal amount of fraud. And Greenspan, Berenson talks about some other things, but the bottom line is that, and the interesting thing that he brings up is that the number itself is a lie, like he says, and that a company's performance cannot get boiled down to one earnings per share number. The numbers that even go into earnings are all estimates. You have to estimate what your revenues are. In many cases, you have to estimate when your uncollectible accounts are, so that goes into bad debt expense. You have to underestimate like warranty expense. All these estimates that go into revenue and expense calculations are all estimates, and so the net income number really should fall within some type of range, and you can't boil it down to one earnings per share number and then divide it by common share. One net income number and then divide it by common shares and get to an EPS number. And then think, well, that one number represents how well a company is going to do and how well it'll do in the future. And the thing is that people don't ever recognize is that if the NASDAQ's growing by 40% a year, then you're taking on an extreme amount of risk. Or if the S&P is growing at 40% a year, the underlying economy, like the GDP in the US, can't grow at 40%. It's just not possible. We can grow at 5-6% as big growth. So if the market's returning 40%, it doesn't reflect the underlying growth in the GDP or in the economy. So you're setting up yourself to fail. You're taking on a lot of risk. And so whenever people get high returns, they seem to think that there's no risk involved. Well, that 40% growth turned out to be fake, and then the market crashed, just like it did in the 20s. And we can create demand for stocks. We can increase stock price because demand for stocks go up, not because the stock themselves become the underlying company of the stock becomes a better company, or it grows. It's just that people want to buy the stock. More people want to buy the stock than sell it, so it raises the stock price. And that happens in bubbles where people just momentum trading, and people just want to buy the stock. So they're taking their money out of real estate, they're taking it out of bonds, they're taking it out of gold, and they're investing in stocks, and that creates this huge demand for stocks, which raises the price. But it doesn't reflect the underlying fundamentals of the economy when the NASDAQ or the Dow Jones is going up 40%. There's no way that the economy can grow that fast. But people don't seem to think that we're ever in bubbles. And so what they did was they took all their money out of the NASDAQ, when it crashed, and out of stocks, and then just moved it over to real estate and said, what's the next thing we can get 40-50% returns on and create a bubble? Well, they did it in real estate. And after real estate, we'll do it for something else. So it's important to think if something looks too good to be true and returns look too good to be true, they are, right? And Berenson says that a healthy skepticism is the best defense against fraud. If we're seeing these huge returns, we've got to be skeptical. What are they doing? And when investors demand honesty about good news and bad news, that's when companies will respond with the truth. But in the 90s, people only wanted to hear good news. So even if the news was bad, like long-term capital management, they spun it to be good. And so everybody wants good news, and nobody wants to acknowledge bad news. But when people really want the bad news and they want the hard truths, that's when you make the best business decisions. And that's when fraud's unlikely to occur. And that's why it's important to read the number in books like this, and we'll do the same thing with Fool's Gold, is we can see the underlying well, the fraud triangle sort of in process. We can see the opportunities to commit fraud. The SEC is not investigating. Auditors are all looking the other way because they're focused on consulting fees and growing their business and not actually auditing. Right? There's incentive to commit fraud because there's billions of stock options out there, and companies, executives, personal wealth tied into how well the stock price performs. Right? You have situations where Alan Greenspan is propping up the market, and people think that it can't fail. And you see all of these underlying things, these incentives, these opportunities, and then everybody's doing it, right? Just like Juan Pablo said, everybody's doing it, and it's okay if I decrease my bad debt expense a little bit to meet my earnings per share targets. I'm protecting my investors. Everybody manages earnings, right? Then we recognize that everybody's EPS is maybe a little bit higher than it should be. I'm just doing what's done in business, or they're able to rationalize it. And ultimately, just because everybody's doing it and everybody's looking the other way doesn't mean that there's not hard truths underneath. And that's what I'm always surprised in, that we get these bubbles like in the stock market and the real estate market, and collectively the market looks the other way and doesn't look at the bad news. And so just because something's growing and everybody seems to think it's a good deal doesn't mean it really is. And so the number is a good book to read because you can see that the fraud triangle in action.